Welcome to the Dealmakers Coffee Break. I'm Asaf Raz. Let's go. Welcome to another episode of the Dealmakers Coffee Break edition. And today we have Seth Grossman. Seth, we know Seth very well, actually. Jamie, who works with us at Agora, knows Seth very well. And he's been running deals, many deals lately with his partners. And he also says he's a pretty funny guy and he wants a podcast for himself. So we're going to test that with our 15 to 20 minute episode of the Dealmakers Coffee Break. Seth Grossman, we're very happy to have you. Please take it away. Tell us about yourself, your business, what you're up to today on real estate.
Sure. I've been, ever since I started working professionally, I was a rabbi for a couple of years, realized that the money wasn't there, but it was very spiritual. But eventually, your kids can't eat spirituality. So
That's true.
went to real estate around 2000, 2001. And in South Florida, Boca Raton. And I've been a mortgage broker since then. Doing commercial mortgages, probably done around $6 billion in the last 23 years or so. And around 10 years ago, really started investing heavily. Invested in a few deals before that, including one that I'm still 1031, and it's now, I think it's now 19 years. And it's growing 10x, thank God. But generally, wasn't my cup of tea. In the last 8-9 years, been investing and raising money and partnering up with a bunch of my clients who serve as a GP, and a couple of them I'm a co-GP, but mostly, I know what I do best will just stay out of the way and let them run the deals and make money. And my friends have been along for the ride. Friends and family have been investing with me for probably the last 7-8 years. Probably total investment dollars of around 50-60 million bucks. And thank God they've seen returns of over 100 million and plus, and a lot of deals still going. And it's really been a great time to invest, especially in multifamily the last 8 to 10 years in the American market, especially the Southeast and the Midwest. What more can I tell you?
That's incredible, Seth. That's incredible. No, that's more than enough. That's amazing. A great background. And I know that we're facing a lot of changes in the industry lately. I know that you've been holding real estate, like you said. The best one is or the oldest property you're holding right now is about 19 years so far, and still providing great cash flow. Oh, there it is. Wait. I want to see that. I need a picture. Show me. Show me.
That's it. More mug. I was sponsored. Nothing more important than your Coke Zero at 3 in the morning to make sure you stay awake for the whole podcast.
I love it. Okay, so I know you told me one of the assets. You told me where you're focused on, and one of the assets that you've been holding for the last 19 years. I think you have enough experience to say what's the situation that we're in right now in terms of the market, right? People are there are a lot of the latest conversations I had were all around interest rates. I want to try to challenge this conversation by not mentioning interest rates and see where we get to, unless we have to, right?
Perfect.
But the idea to understand from you, like, what is the situation right now? You've been in the business since 2000. You know everything about this business. What do you feel about the situation right now in the market?
Sure. Just I'm not going to say the IR word, but first of all, I don't say the word IRR either, because I think that's just almost as fake word as interest rates. But as a mortgage broker, I'm super bored about talking about interest rates. But as an investor, I think it's almost irrelevant. It's important to, as you evaluate how much you could pay for a certain asset and how much, where your cash flow is going to be, et cetera. But the bottom line is that you really got to stick to the fundamentals. It has nothing to do with interest rates. You could you could buy an office building right now and get 2% interest, and you're not going to make enough money to cover yourself because the fundamentals are there. People are working from home. People don't want to travel. Even people are going to work. They're really flight to quality. They're just going to the higher end offices, and B offices and B minus and even B plus offices are suffering, and that has nothing to do with interest rates. Because the same thing with multifamily deal. Frankly, rents have gone up much more proportionally than in terms of your in absolute numbers than interest rates. We've had deals in Texas. We're doing deals in Texas now, and again, in B minus areas, Irving, Texas, stuff like that, where we bought in June and we're up 35-40% of rent since June. That's 1 year. So I haven't a full year yet. We bought at the end of June. You gotta find places. People always need a place to live. And in fact, it's the opposite. Here, the interest rates probably helped us in a lot of ways in the multifamily business, especially for deals you've already owned, because, people can't afford houses. The down payments are still incredibly high. their monthly payments are incredibly high. They can't move. And in places where there are very high barriers to entry, especially again in Texas, we're doing deals. I'm doing deals in Atlanta. I'm doing deals in the Midwest. I say the only area where I'm doing a deal where that's not true is in Alabama. I have a beautiful deal in Alabama, Huntsville, Alabama, doing amazingly. But I know there are 14,000 new units on tap to be built. I hope we'll continue to do amazingly. But in a place like that, even though Huntsville's one of the most growing, markets in the country, if so many new buildings are coming online, it could be that at some point, there will be some pressure to keep the rents the same or even downward rents. But almost every other property I'm in, and I'm probably in around 25 multi-deals now as LP or co-GP, we're seeing the exact opposite. There's the replacement costs are so high, people can't build new properties. The land cost, even for existing, is super high. And so therefore, your current markets, as long as you take care of your buildings, take care of your, treat your tenants well, you're raising them 10%, 12%, even 15%, and they're begging to stay. So, and that's even without doing some renovations. We'd like some of the deals, we'd like to do, upgrades on the buildings, but that's only upon vacancy, and most people are leaving. So we're not even spending the CapEx dollars that we put aside. So we're not distributing them, because we want to have them if we need them. But I mean, the cash flow has been amazing. And really the properties have gone up in value. And also when you come, even inflation, people get the scary word. And real estate, it's not a scary word, because at the end of the day, everything goes up. Your rents go up, but so do your expenses. But one thing that doesn't go up is your mortgage. So your mortgage is stuck. If you bought a building for $45 million and you have a $30 million mortgage, and now everything's gone up 20%. So your building's worth 20% more, your expenses are 20% higher, everything's higher, but your mortgage is still $30 million. It's actually an advantage for real estate people, besides for the tax deferred, all those things. It's another advantage of investing in real estate, especially as an LP, and whether that's in Israel or America, they're both treated well, especially with depreciation. You defer your taxes. It's the best asset class out there, so long as you're responsible GPs who aren't in it just to make themselves money, who make sure their interests are aligned with their investors. And you really could do well, and help you and your family, have cash flow that you never expected.
That's a great insight into real estate. You made it so simple. People sometimes make it so complicated, but like you said, real estate never dies. People need a place to live. I do want to focus on one thing though. You told me Boca Raton, right? Is that true?
Yeah. I'm actually filming from Boca Raton right now. I'm on a quick work trip for a week. So you're actually there right now, but you've in the past years that you've been in the business, you expanded to properties in Alabama and Texas, right? You've expanded throughout, like nationwide. How do you choose those specific deals? How do you ensure that those deals make sense, even if it's in a state that you're not, quote unquote, a professional in or haven't been there in terms of running a deal? How do you make that choice? Sure. And I'd say the most important thing is that while we invest, it's actually one of my investors. He never even invested with me, but he's considering investing with me for the first time. He sent me an email yesterday, and he said it great. He said, at the end of the day, you're investing with people, not properties. And that's true. The most important thing is to pick the right partners for the right areas. I have a guy who I'm close with, actually hopefully meet today. He's based in Aventura, but he used to live in Texas. I invest with him in Texas. He's got 15 deals in Texas, in the Dallas-Fort Worth area. He's been to Houston, which is, again, not same market, but close enough where he understands it well. I don't think I'd invest with him in Alabama or in Cleveland, whereas I'm doing a deal now in Cleveland and Louisville with a bunch of guys, and actually, I think Jamie and a group of you guys know him. It's RW Equities and Adam Parkoff and Jay. We're all partnering together, and we use Agora, and Agora is great. And we closed on a deal in the Midwest in Indianapolis, December 20 something or whatever previous year, and now we're doing two more deals in Louisville and in Cleveland, all in the same region. That's where I'm investing with those guys, because those guys are experts, and that's where they're focusing on. And it doesn't make them where you live. I actually met with one of the partners the other day in Baltimore, but he doesn't buy in Baltimore. He buys in Midwest because that's the area he knows. And so and then with the third guy, I'm investing in Florida. They have 5 properties in Florida. And so even if I don't know the areas, I know most of these areas pretty well. And, maybe at the beginning I didn't, but it's really making sure you have the right people with the right investments. And not some guy who just looks at, gets a Excel spreadsheet, gets a package from from Marcus Millichap and says, hey, let's go, let's buy this because it looks like it's a good cap rate. I'll actually tell you a funny story, which I wasn't planning on telling this one, but this is a true story. And again, I'm Israeli now. I've lived here for 14 years, so I don't make fun of Israelis. But there was a guy in Israel, a guy who works for me, set up a meeting with me. He's a very, very successful investor from Israel. He probably has hundreds of millions of dollars invested, and he's done really well for his investors. Yeah, he kind of puts together a lot of investors from Israel and then invests with his local partners in America. But this was around 12 years ago. And he was relatively new. His business was not real estate. He was just starting this. Now he's become super, super successful. But then he calls me to his office. He said, "We got to do this deal. Get me a mortgage. It's an amazing deal in Manhattan, a 7.5 cap rate, multifamily." I was like, "What? 7.5 cap rate in multifamily? That didn't exist in anywhere." And in Manhattan, I literally drove to his offices in the Tel Aviv Ramat Gan area, whatever. Beautiful office, by the way. I get there. He shows me the deal. I'm like, listen, I'm from New York. I grew up in New York. I figured I'd recognize this from the pictures, the area. This doesn't look, there aren't any big buildings anywhere. It was Manhattan, Kansas. And I only know about Manhattan, Kansas, not because of real estate, because growing up, I was obsessed with college basketball. And so that's actually where one of the main colleges, one of the more famous sports teams in the college basketball world is. But he was ready to invest millions of dollars in a deal because it was in Manhattan, but it was Manhattan, Kansas. Like only Dorothy would invest in Manhattan, Kansas. And obviously we didn't do the deal, but that's crazy. Like, you really got to know, he probably got it from some guy in America, tried to take advantage of some Israeli who didn't know it. He told him it was in Manhattan, and he was probably hoping he would commit a few $1 million. And today, I'm sure that deal, went on to 3 times already since then. And it's really what and doing the research, but do it with the right people you could trust and know their areas. If you stick with those people who know their businesses and do what they do best, which is one thing I want to say. People ask me all the time, you've been in the business for 24 years, you raise all the money for the investors, why don't you just go and buy it yourself? And then you'll make the promote, I say all the time, I would love to do it, but I don't know anything about actual, mortar and bricks. I don't know if it's wood frame or steel. I don't know if it's going to have a sinkhole. That's not my expertise. I'm a numbers expertise that grew it to understanding real estate, location, etc. But I'm not a mortar and bricks guy. I don't understand that stuff well, and I wouldn't risk other people's money on something where I'm not the expert. I made that mistake a long time ago, trying to deal with stuff where I don't know enough. Now I stick with investing and raising money with only stuff that I really understand well. Let the professionals do what they do, and I'll get the mortgage. I'll do the investing. I'll raise the money. You stick with what you're good at. That's probably why I didn't do my podcast yet. I don't know if I'll be good at that either. We'll see. Maybe I'll stop. You'll be the one who jumpstarts my podcast career.
You'd be great. I think this episode is going to be definitely a jumpstart to your podcast career. I'm really happy to hear that. So following up with that question, following up on what you said, you said you focus on the people, and you're specifically an expert in the fundraising, like raising capital, managing the investor side, and you let the professionals do what they do. So within your profession, right, do you usually have a choice of the type of asset you're going to invest in, or is that always dependent on the people? So for example, are you more of a multifamily focused, industrial real estate, strip malls, office spaces, or are you just working by the opportunities and the people that bring in the deals, if that makes sense?
It makes perfect sense, but it's a little bit of both. And that's because I've done, as a mortgage broker, I've been involved in every single one of those, spaces that you mentioned. As a personal investor, I'm invested a lot in office space in Texas, and, a little different than the multifamily area of Texas, but a much, more high-end Dallas area as opposed to the suburbs. But I'm always the one deciding what I invest in, because I don't commit to anybody. I'll do a mortgage for anybody. I mean, unless you're doing fraud, which I've had a couple of those people. But yeah, in 24 years of business, you have guys just switch rent rolls and stuff like that. And then you just walk away. It's not worth the commission, both morally and even financially. Just those guys end up paying for it in the long run. But in terms of mortgage, I'll do it for anybody. I know I do mortgage with any of those and many other asset classes. But in terms of investing, I never commit to raise money for any deal. Any deal that I raise money for is because I want to invest in it personally. I've done the due diligence. I'm comfortable with the people. And those are the deals. And then I invite my friends and family to invest alongside. But I don't tell the guy, I'm going to raise you $2 million. I'm going to do 40% of your raise. I'm going to do 60%. I don't commit to anything because I don't want to ever pressure anybody. It's not my main business. My main business is the mortgages, and I'll invest for myself. And there are plenty of deals that I'll invest in, maybe not a ton, but I'll invest in more for the relationship with the client but I want to bring other people into that deal because I don't necessarily feel the deal is amazing. It's just for me, I have a vested interest in having a good relationship with that client, but that's never a deal that I would bring other people on. I only bring other people if I feel comfortable that I really think the deal is amazing. I suppose if you're doing the mortgage and you're making a $200,000 commission, so you're putting $100,000 into the deal, I could take that risk because I'm still going to be net up, and I have a client who feels I'm loyal to them and blah, blah. But you can't invest your friend's money because you're making the commission. So that's where it's good that my money is not made from raising money. That's not my main business. So I can really be honest. And I've even lost mortgage business by telling people I don't want to invest in deals I'm not going to raise money for because I don't believe in the deal. But thank God I'm in the position where I'm not forced to do it. So I always choose what I want. Right now I'm focused on multifamily because that's what I believe in. Frankly, retail's coming back for the right retail deal. If it's really anchored, maybe I would do that, but I wouldn't do an office building right now. I'm doing a deal at Baltimore that's converting hotels into like more shorter end multifamily deals. But it's really important to stick with what you really know and understand, and you got to go with it. Listen, I have a Walmart deal that I invested 10 years ago, and we're refinancing. It's doing great. But would I invest in a strip center with no anchor, with internet related tenants there? No. So as an investor, you get to choose. You're never responsible. At least I'm not. I never am required to invest in any deal if I don't feel comfortable in it, and certainly not to raise it from other people.
This is the opportunity in the episode to do what we call a shameless plug, which is when you say how people can reach out to you. What are you looking for today? What are you open to discussing today? We did have some great LPGP connections through the podcast that they were very fruitful into investing in deals. So it's a great opportunity if you're looking for something like that too.
I mean, who's looking for shameless plugs? I would never stoop to such a level. But since you asked, we happen to have 2 deals. I'm working on 3 deals right now. One of them is just about finished, but it's a really nice deal in Texas. That's in Irving, Texas. Great sponsor. Been doing it for 30 years. Invested with him. Probably I've worked with him for 10 years. But he uses a thing called Juniper Network. So I was told him we can't do a shameless plug for you on this podcast because Juniper doesn't compare to Agora. So let's focus on the 2 deals that I've gone with that we're using Agora right now. And that is we're buying a 623 unit deal in Cleveland, Ohio. Really low per unit, by around $57,000 a door, $36 million purchase price. The sellers, hopefully they're not watching. Well, if they are, maybe they'll be inspired to do a little bit. They're doing a terrible job managing it. Their payroll is $1,900 a door. Their repairs and maintenance, I think my kids could probably keep the place in better shape for less money than they're spending. It's really an opportunity where their NOI is lower, but the deal still cash flows now. The rents are probably $200 below market, and we really think there's an opportunity without spending a lot of money to really jump the margin significantly. Which I just went out to market with that deal this past Tuesday. Already have, I think, 16 guys committed already, so it's gone pretty fast. But it's the $13 million range or $16 million range. But what's nice about this deal, and again, it's the same thing with the second deal I'll talk about was the Louisville, Kentucky. It's with those guys we spoke to before. They're only in the Midwest. It's my friend Noah. I'm not gonna say his last name. I can't pronounce it with a W. It's really long, and he's like my cousin, but I still can't pronounce his name. And I think it's gonna be Ramras. And then we partnered together with Adam Parkoff, who's from 4th generation real estate guy from the city, who really is a lot more money to be made outside New York than inside New York, especially after the rent control laws. And we've already done a deal together. We've been talking for years. I used to babysit for his wife. That's how I got to know Parkoff. She probably doesn't remember me waking her up so she could change the little kid's diapers because I wouldn't change diapers. That's only so far I would go. But we've been friends for 20-some years. These are the first few deals we're doing. Was a couple of years, and we talked about it for years, and now we did the deal last year, do 2 more. I mean, we're looking at very high return teams. We don't refinance, but the goal is to refinance in 2-3 years, pull out a bunch of equity. We're looking at probably in the mid-20s IRR. They claim 30s. I always like to, do a little math, which we always lower by 20%. Even if I feel it's realistic, that's what I'll do. And it's cash flow from day one. You get a quarterly check from go through the Agora platform. It's great. You sign up, you put in your information, and we on the last deal, I think we're 40% above what we said we distributed in the first quarter, and the second quarter is doing great. So that's the deal in Cleveland, Ohio. There's another deal in Louisville, so about half the size in terms of units. It's around just under 300 units, but it's the same thing, a little bit mismanaged, a lot of room in the rents. There's actually a big plumbing issue, which we know how to fix. And they probably double their water bill is double the amount. They don't have the capital to put it and fix it. We're going to put it as part of our CapEx, and we think we can save $1,000 a unit in water bill. Now that's tremendous to the bottom line of 300 units. That will be a quick plug, jump to the NOI. Again, those deals, I didn't even send out the Louisville deal yet because my investors are incredibly smart because I do one at a time usually. But anyone's interested, my email address is Seth G. That's SETHG at crefadvisors.com. It's a commercial real estate finance advisors.com. When we go to these conferences, people think I'm Cref, TIA Cref. I never tell them they're wrong. But it was just like the only thing that was available on GoDaddy like 15 years ago when I started it. Again, it's Seth G at crefadvisors.com. You can call, WhatsApp me at 561-703-5269. We're very generous on the promote. It's in favor of the investors, 8% pref, then a 70-30. And what's nice about what I do is because I put a whole group of people together, we get a little bit, we're able to let people invest smaller amounts. 50 grand is, 50 is 100 grand minimum. It's really 50 grand. But I don't take any money from the investor side. In other words, I let them invest directly into the LLC. I don't skim off the top. As I said, it's not my main business. My main business is the mortgages. This is really just kind of a service I do for my friends and for my clients. And everyone's happy with me. It's a value add for clients. I'm not a righteous guy who's doing it for no reason. It helps me too, and it's been great. And every once in a while, my friends take me out for dinner when the deal sells. I'm not a cheap date. I'm not getting the chicken. I'm getting the steak, and then I'm getting the hamburger as the appetizer. So it's an expensive date, but usually I made them enough money where it's worth it. So thank God.
I love it. Seth Grossman, thank you so much for joining us on another episode of the Dealmakers Coffee Break. Thank you for joining us. Check out more episodes on the Dealmakers podcast, available on Spotify, Apple Music, Google Podcasts, and Agora's website at agorareal.com/podcast. See you in the next episode.